Hello students, can I get a confirmation from you all in the chat box if you can see the screen? Can I quickly get a confirmation from you all in the chat box if the screen is visible? Excellent. Thank you very much, students. Thank you. Now, I think students, you have to make sure to have a look at the answer of Mr. Lennon. Actually, he's in a turbo mode, doing very well, and I'm very happy for that. So it's a good answer from Lennon. Have an idea. But I'm not going to replicate the answer of Lennon. I'm just going to give you the technical explanation, plus also the applied thinking, what is required in the examination. Now, one of the weakness I observe in our classroom was the technical knowledge. So I have to design something relevant to you. So weakness was technical knowledge. That means it's very weak area. We have not to waste on the weak area. The management strategies, you should focus on your strength and gradually improve your weaknesses, but don't go to directly improve your weaknesses. You will lose your strength. But strength, if I say, if I'm not mistaken, strength, I can say in our class is common sense. The good strength I really appreciate is common sense, which is what we need in today's era, because ChatGPT, yeah, it will do the work for us, but the question of doubt is common sense is still dominating by the human intelligence until now. So I'm very happy with the answers provided by other students because I see a lot of common sense in your answers. Excellent. And the structuring of the answer was perfect, because that is one thing very important to say, like structuring has been perfect. And I think Rahul, if you are there in the class, very happy for your growth. You have had 100% changeover in your marks compared with the last marks. That's the progression factor. We have to always make an ordinary person extraordinary. That's the target should be. Now, students, before I start teaching you this question, I have to quickly give you a summary of business valuation. So I'll just guide you in this area of what students, business valuation. Students, can I quickly get a confirmation from you all in the chat box, students, if you can see the board full screen, because it's business valuation. I'm just teaching you the basic factors first. Yeah. So students, if you see business valuation, okay. So valuation will do, when we read English, you have to always break it down. Valuation means identification of a value. Correct, no students? Identification of a value, Business means a company. Okay. Business means a company. Business value means company's value. How to identify a company's value. So this is applied in a situation of merger or acquisition. Because students, when you're going to buy an organization, then it needs to be a business valuation. Example, if you see in India, Tata acquired, I think, Air India. Correct, no students? I think Air India is currently owned by Tata. So they did not do just go and buy the company. You have to do a valuation. And I'm going to teach you how companies estimates a value of a company. So students, if I'm not mistaken, the first valuation technique that everyone usually follows. So I'll write down here method and application. Method, and here what I can say, students, application. So shall we work on the first method? The first method is very easy. That's called as the book value method. What method, students? Book value method. Actually, students, book value method means you take the cost minus accumulated depreciation. Correct, no students? That is book value. Cost minus accumulated depreciation. We also say that as a net book value, and everyone is very much aware about that because these are basic financial accounting. Now, students, let's move on to detailed application. So in a financial statement, we can find the book value very easily. The value of the organization, if I'm not mistaken, we just say assets equals capital plus liability. Correct, no students? That's how we effectively derive the accounting equations. And equity, also another term we generally use for a listed organization. Now, students, if I want to identify the value of equity, it's very simple. Equity equals asset minus what, students? Asset minus liability. So book value based valuation is done directly taking the financial statements. You compare the asset value and the liability value, take the difference, and you will get the equity value. So students, can I quickly get a confirmation from you all in the chat box, students, if you got that idea of equity equals asset minus liability? Can I quickly get a confirmation? I will do the application with the question more in detail, but for the time being, are you clear with the book value, students? This is only known as book value. Thank you. Thank you very much, Linon. Thank you very much. Thank you very much. Excellent. Now, students, drawbacks. So if you see the drawbacks of this, very simple. Intellectual capital is ignored. Correct, no, students? Because intellectual capital means the brand, the customer reputation, all are ignored, if I'm not mistaken. And another thing is the manipulation is sure, 100% manipulatable. Depreciation is there, right? So when you increase or decrease the depreciation rates, there is high chances of manipulation, estimated useful life, everything. And then students, another drawback, if I'm not mistaken, ignores the real value. Ignores the real value. Real value means, students, the value including indexation. Including what, students? Indexation. Students, I believe you may be aware about the term called indexation. That is the inflation adjustment. Because these are historical valuation. Where it is used. So can I write down here where it is used? Where it is used? Loss-making companies. Loss-making what, students? Companies. Loss-making companies without any future. Without any what, students? Future, we go for the book value method. Example of a loss-making company where there was no future, if I'm not mistaken, Kodak. Or you can say another one, Nokia. They don't have future. And if you come to the Indian perspective, students, suppose if you see a government sector organization is getting sold for some other construction purpose, then we go for the book valuation here. So can I get a confirmation from you all in the chat box, students, if you are clear with the book value method of valuation? Can I quickly get a confirmation from you all in the chat box if you are clear with the book value method of valuation? Thank you. Thank you. Okay, so students, now the next one is the slightly opposite one, that we call it as the market-based valuation. Market-based valuation. Students, very simple. We have something called market capitalization. Market, what, students? Capitalization. It is equal to a very simple thing. Number of shares multiplied by market value per share. Market value per share. Now, students, you get the market capitalization, but this can be only listed companies. Listed companies can apply. Or you need a proxy company. Or you need what company, students? Proxy company. Are you understanding? Proxy company means if you see Coca-Cola, what is their proxy company for comparison purpose? Pepsi, right, students? So that is only known as a proxy company. If Coca-Cola is listed in the stock market and Pepsi is not listed in the stock market, you have to use Coca-Cola as a benchmark and compare with Pepsi. Can I get a confirmation from you all in the chat box, students, if you are clear with the market-based valuation? Can I quickly get a confirmation from you all in the chat box if you are clear with that? Thank you. Excellent. Now, actually, if you see, this market-based valuation is used to acquire minority stake. To acquire what stake, students? Minority stake. The purpose. Minority stake, another technical term you would have learned is for students. Non-controlling what, students? Non-controlling interest. Another term we can call it in financial management as private placement. What is the term here, students? Private placement. Students, can I quickly get a confirmation from you all in the chat box? Market-based valuation. And personally, if you see everywhere, market-based valuation is something that is mostly preferred. Market-based valuation is something that is mostly preferred. Can I quickly get a confirmation from you all in the chat box if you got that clarity behind market-based valuation? Excellent. Thank you. No problem. Now, students, let's come to the next one. So I believe these things are very easy and simple. The next one is going to be, students, something called cash flow based valuation. Cash flow based valuation. And I think this is the best valuation tech companies or everyone do it. You take the present value of the future estimated cash flow. Based on business life cycle. Based on business life cycle. That means, students, you are not estimating the value only based on today's market price. You think the potential. Now, example, students, if you are going to invest in ChatGPT, let's assume Microsoft is the owner of ChatGPT. OpenAI belongs to Microsoft. So if you observe, students, if someone is going to buy ChatGPT, they will be always thinking about market value today or the present value of future cash flow. Present value of future cash flow. Can I get a confirmation if you understood the ChatGPT valuation? Because we can't do a valuation for ChatGPT based on market based or based on the historical cost. We need to go for cash flow because potential is very high for ChatGPT. Correct me if I'm wrong, students. Mark my words, students, next 2-3 years, everyone's laptop will have a ChatGPT like everyone has WhatsApp in their mobile phone. Can I quickly get a double Y in the chat box, students, if you are clear with that ChatGPT Open AI example? So present value of future cash flow. So you estimate it. So there are big challenges. What are the challenges? Cash flows are subjective. Cash flows are what, students? Cash flows are subjective. Correct, no, students, if I'm not mistaken. Very much time consuming. Very much time, what, students? Consuming. Makes sense, no, students, if I'm not mistaken. The second thing, students, just to make your life even easier and simple, the discount factor is subjective. You don't know how you are going to take. Discount factor is subjective, And one biggest challenge is there can be industry disruptions. There can be industry, what, students? Disruption anytime. Industry disruption anytime. Example, students, if I give you an example very openly, this AI industry effectively is causing a disruption. I think everyone is aware about that, and the disruption affected the coders more than anyone else. Students, are you understanding what I'm saying? Coders only got affected because ChatGPT can effectively do the coding functions even better than a human being. So can I quickly get a confirmation from you all in the chat box, students, if you got that idea of cash flow based valuation? You think about the future span and you invest. You think about the future span and you invest. So this is again a recommended approach. So can I just make sure this is again a recommended approach. This is again a recommended approach. Indian Premier League, English Premier League, all these football league, NBA, all these things were done using the cash flow based valuation. The next one, students, is PE based valuation. I think we call it as earnings based valuation. This is actually, students, a stock market speculation technique. But in reality, this is not a correct valuation, but this is a technical model. So PE ratio, what does PE ratio means? Price divided by what, students? EPS. What does EPS stands for? Earnings per what, students? Earnings per what, students? Yeah, students, can I quickly get a confirmation? So price divided by earnings per share is only effectively known as PE ratio. Now, students, how do we do the estimation? Very simple. PE ratio, you take the PE ratio, you multiply it by the today's EPS, you will be able to get the market price. It's very, very simple. Now, PE ratio means price. Okay, PE ratio means price. And I can effectively say price, I'll underline this, divided by EPS. Price divided by EPS. And then, if I'm not mistaken, I'll just put this multiplication sign, price divided by EPS. Price divided by EPS multiplied by EPS. So what happens? This EPS will effectively get cancelled. This EPS will effectively get cancelled. Correct, no, students? If you multiply price earnings ratio with EPS, it will effectively get cancelled. It will effectively get cancelled. And then students, once it is effectively cancelled, the balance what you are going to have is the market price. So students, this is a stock market estimation technique. Can I get a confirmation from you all in the chat box, students? That means investors will not rely. This is just a signaling effect. What is that, students? Signaling effect ratio. Like when you look at a cricket match, they have something called the win predictor. So this will effectively say, suppose, let's assume the EPS is reducing. What will happen to the market price, students? If the EPS, now let's assume EPS is going down. Now see an example, let's assume 100. Okay, let's assume the situation in this case is 100 divided by situation 1, let's assume 20. Okay, multiplied by 20. Okay, situation 100 divided by 20 multiplied by 20 divided by 20 multiplied by 20. So 100 divided by 20, if you observe 5 no students, 100 divided by 20 is 5. I'll just put a bracket here. You can do the direct calculation, but I'll just do a bracket here. So 5 multiplied by 200, again effectively it will be, 5 effectively by 20 effectively will be 100. So this is the estimation when the EPS, the earnings per share, is effectively at 20. Now let's come to a second situation. I'll just give you a scenario plan number 2. The same thing, let's assume the price today trading at 100. The price is trading at 100. And let's divide it by, it is reducing by 10. 100. Let's divide it by, it's reducing by how much, students? It's reducing by 10. Multiply that again by 10. What will be the answer? Once again, if I'm not mistaken, 100. So if you see, students, this is just an estimation technique. Are you understanding what I'm saying? There is no effective changes based on the EPS value. Sometimes the market signals, example, if this changes, there will be a change here. So this is just a signaling effect ratio. Can I quickly get a confirmation from you all in the chat box if you understood that there are no bigger deals here? Do you see what I'm saying here, students? It's just a signaling effect ratio, and they generally don't test this in the examination because these won't work in strategic level. This is very good for investment banking purpose only. So the next one, students, if I'm not mistaken, is called the dividend valuation model. This is again done to the investors, not for company investors. If you want to buy investor shares, the NCI shares, present value of future dividend, present value of what, students? Future dividends, you need to calculate it. This is only applied for NCI, only applied for NCI valuation, non-controlling interest. And the last one is, students, CIV, that we technically call it as calculated intangible, what, students? Calculated intangible value. So in that case, it's not so complicated, students. What we do is we take the market value of the company minus industry market value of similar company. That is intellectual capital. I give an idea. Okay. Example, students, Microsoft and Apple, iOS. Now, if you see an Apple MacBook will be very expensive. Now, the lowest MacBook, let's assume, is costing $1,000. And if you see the lowest, Microsoft will effectively cost $200. So why consumers are paying $800 extra is for what capital, students? Intellectual capital. Intellectual capital. So students, can I quickly get a confirmation from you all in the chat box, students, if you got this application properly? Can I quickly get a confirmation from you all in the chat box, students, if this is clear? So these are the valuation techniques that are generally followed. But for your case study examination, the 3 comparing one is book value. You will get very, very minimalistic marks. And then market value based valuation, minimalistic mark. but the highest marks is given how you think about the future. These three evaluation models, I'll just make it with a light gray color. These three evaluations are effectively students considered to be a lower valuation. So any questions you like to ask, you can ask me, students. But if you are fine with this, can I quickly get a confirmation from you all in the chat box if you are fine with all this valuation technique? Any questions you like to ask, you can ask me. Doctor, are you clear with this? Can I get a confirmation from you, doctor? Are you fine with the valuations part?
Yeah. I'm not
Thank you.
used to with the last one.
Calculated intangible value.
I have never heard of that, but I have heard of the rest.
Thank you. So students, I believe these are the valuation techniques that we have to keep in mind. Example, let's assume an Uber. Now, if you see company like Uber, they are effectively based on the calculated intangible. The best value is cash flow. This is the best valuation. You value a company based on cash flow. SpaceX, Elon Musk, everyone, what they think about the futuristic cash flow which will be generated in 20 years time, 30 years time. And that's what Netflix, you see a company Netflix started in 1997. Netflix is a basic example. They started in 1997 and Dr. Netflix became popular in 2019. So this is valuation. So the people who invested in 1997, they didn't expect the immediate return. They were focusing on the cash flow, what can be expected in the future, and effectively they got that successfully. Any questions, students? Can I get a confirmation from you all if you are fine with this so that we can effectively go on with the question? Because that is the technical recap what we have done. So now I think the majority of the students in the class may find it very much easier to work on with the rest of the parts. Okay. Students, let's start working. Firstly, evaluate the bid price for the shares of 60% based on the information we have for the valuation. Evaluation. So I'm going to write down a heading first. That is the part A requirement. Evaluation of the bid price for 60% stake in Robobryce. So we have to do technical application, and I think Linon has done it well. Secondly, evaluate the risk we may face in case if we sell 60% stake to favorable. So evaluation of risk we may face in case if we sell stake to favorable. Are you getting that point of view, students? Can I quickly get a confirmation from you all in the chat box, students, if you are fine with this? I believe this is giving you more clarity on how to think and how to apply. So make sure you frame your question before you start your question. That is very critical. And time management is very, very important. Now let's go through this. You have received an email from Eva, potential acquisition request by Favrobot. Recently, the chairman of Favrobot has met me formally in a coffee shop. Initially, I had an idea, maybe due to the extend the service period for non-autonomous equipment. However, the conversation was different. He was stating that they need to increase the production of AMR and AGV, okay, and some new technology. Therefore, with current capacity, they are not able to produce. So he has requested 60% investment acquisition stake at Robobryce. So they are expanding. So they are planning to expand by acquiring factories. So the process will be very, very faster. They are saying the chairman of Favrobot has not forced us. He doesn't want a hostile takeover. He has already told there are some players he approached as well. And he only wanted a bid price for 60% stake of investment. Therefore, they can do the due diligence and the legal requirement as well in order to go ahead with the business proposal. Further, he has asked me to estimate the value for the investment stake as well. I have responded to him that I may need 14 days time since I have to consult the non-executive directors as well. And also I need to inform the shareholders in case if you are able to invest 60% stake in this firm. I hope you are clear with the above incidents. So we have to do the estimations. Now, the first thing, students, the usage of pre-scene, the main objective of this was the usage of pre-scene. Now, first thing is book asset-based valuation. Doctor, can I work with you if you don't mind? So that I will get the clarity of the understanding of the class. Can we work together, Doctor?
Sure, sure.
So, Doctor, if you observe, if you are going for book asset-based valuation, you have to take the value of equity. Correct. So what I have to do is I have to do the total assets. That is at 2022, what is the value of the total assets? 24,739 asset value. Everyone is clear. So this asset value has property, goodwill, software development, inventory, tangible, bank balance is also there. And if you see the next factor I have to consider is the liability. What are the total liability? The borrowing is 11,000, trade payable and tax is 2,286. So I can say it's 13,286. That is the liability. So effectively the equity value is the difference between these two. So technically speaking, it should be 11,453, which is the equity. Can I quickly get a confirmation from your students if you are clear with this? Can I quickly get a confirmation from you all in the chat box, students, if you are clear with this? So the equity based or the book asset based valuation is 11,453, and of which if you multiply 60%, you will be getting the answer. If I'm not mistaken, students, just give me a minute or a moment. I'll take out the calculator. $11,453 into 60%, 6,872. Students, can I quickly get a confirmation from you all in the chat box if you are fine with that estimation? Any questions you like to ask, you can ask me, but can I get a confirmation from you all if you are fine with that calculation? Doctor, are you clear with that pricing?
Yeah.
Yeah. So students, can I give a note for that so that it will be very easier? Firstly, as a general principle, the company needs to estimate the book value based on the net assets, where in this case, the net assets are T dollars 11,453 million, where 60% stake is 6,872. This is ignoring other factors such as our potential in the research and development and the technology we are using. Therefore, this can be used as the lower limit. This can be used as the lower limit. Students, can I quickly get a confirmation from you all students if you are fine with this calculation? If you are fine with this calculation, can I quickly get a Y in the chat box, students? Thank you. Thank you. Now, students, moving to the next one, the market value. There is a general rule. Students, now you see here, we have 800 share capital. So we always say in the UK or the US term, the nominal value of one share is $1. Okay. So in this case, 800 divided by 1 means the issued shares are 800 million. Students, this is a general Companies Act rule. The valuation of one share is $1, minimum $1 in that countries, the base limit. Can I quickly get a confirmation from you all in the chat box, students, if you are okay with that? That means I took the number as 800 million shares. Thank you. Now, students, let's look at this one. Now, in this case, students, if you observe, if I'm not mistaken, I think for the benchmarking purpose, I can say the price of the share today is somewhere around 100, let's say. So 800 million multiplied by $100 per share in today's term, if I am not mistaken, that will effectively give me an answer of $80,000 $3.80 million. Students, so do you see the current market value is $80,000 million, but the book value is only 11,453. The rationale behind this is assets are always recorded in historical cost. Meanwhile, if you see, the market value is the today's value. So 60% of $80,000 will effectively give you how much, students? 48,000. Correct or not correct, students? Can I quickly get a confirmation from you all in the chat box if you are clear with that, students? Can I quickly get a confirmation from you all in the chat box if you are fine with that? Thank you. Thank you. Now, students, I will come to the next one. Secondly, the market price can be observed as $100 per share. The share capital issued is 800 million. Therefore, the total market capitalization is 80,000 million into 6%. That will be $48,000. Correct now, students? I believe everyone has got that clearly. Now, the next one, I will continue the next one. Therefore, in this case, this can be a good range, but what will be the benefit for the shareholders who are selling the stake? Now, students, in a situation, students, you see here, I told you the market is a bear market now. Prices are going down. When the market prices are going down, students, buying is the correct strategy. That is, it is done very well by Tab Robot. They need to buy it. But when these people are selling the stake, there needs to be some capital gain. Therefore, for Pavrobot, there needs to be an extra premium on redemption to be considered, because they have to pay extra premium on what, students? Redemption as well, because above the market price they have to pay. Now, if you see in our point of view, these are the ranges of price, but you will still feel when you are buying a company for very expensive amount, it does it matter is the question. Now, let's come to the next one. Thirdly, the cash flow based valuation can be adopted, since in that case, the business life cycle is considered and a valuable estimate can be made. Make sense now, students? Yes or no, a valuable estimate can be made. In that case, the company needs to make sure that they are able to have a better understanding of the future trend. Example, like the supermarket price war. Can I quickly get a confirmation from you all in the chat box? How many understood this supermarket price war? Now, I think Linon all should make sure you have to integrate it, students. Can you remember there is something called supermarket price war they have given? Can you recall that, students? Supermarkets are having a problem. And in case if the price war continues, indirectly we will get affected. So in this case, if you write, you are surely a world prize winner, because this is the integration of the students that is needed. Further, another factor can be development of new technology. LiDAR. Can you remember, students, LiDAR technology? If I'm not mistaken, students, I think I am correct. LiDAR, right? LiDAR. Where the existing ranges of products become obsolete. Students, are you understanding that point of view at the moment? Can I quickly get a confirmation from you all in the chat box if you are clear with that applied way of thinking? In this case, the price may be even higher. The price may be even higher. But there is a complication in estimation due to uncertainty, complexity in application due to uncertainty. Anything can happen anytime, students. So that is one factor. Thank you. Now, students, if I'm not mistaken, now these three are the main thing. You can write P, dividend valuation, CIV, everything, not an issue. But the next thing is you have to be very practical. Fourthly, we can also ask the budget range of Pavrobot. That is how much they want to pay. This may provide a better indication for the company as well. Correct now, students? Can I get a confirmation there? Because you ask, because sometimes the best valuation technique is asking from the counter buyer how much you want to pay. This will give a better indication of the value rather than focusing on technical estimates such as PE valuation and also dividend valuation or calculated intangible value. is one factor. Further, since there are only 6 players in the market, there is always a scarcity. So the price can be demanded. Full stop. Students, are you now clear with the evaluation of business valuation? Can I get a confirmation from you all in the chat box, students? Think like very practical here. I'm just summarizing this just to make sure you are getting this clarity properly. Any questions you have in this evaluation of this bid price here, students? Can I quickly get a confirmation from you all in the chat box? Are you fine with that? Can I get a confirmation? Thank you. Thank you. Thank you. Okay. Now, what are the risks we may face in case if we sell the stake to favorable? It's a big thing. It's one reason why many students don't pass SCS, because they don't think very practically. Now, even in our class, even Linon has not taught it. You see, students, the biggest risk is financial risk. I'll tell you why. Students, what is the borrowing here? We are 11,000 and the equity is 11,043 with the retained earnings. But in the previous year, our gearing was very high, 11,000, 50% gearing. And here, again, the gearing is very high. So the biggest problem is, will the bank allow two extremely geared organizations to merge? Doctor, what do you think? Can two extremely geared organizations merge?
They definitely can, but the banks won't like it.
Banks will not allow it. Correct, no, doctor, if I'm not mistaken.
Yeah.
The default risk will become high. Agree, no, students? Can I get a confirmation from you all in the chat box? Are you getting that point of view, students? Two highly geared company, the covenants will be there. The agreements will be there. They will avoid them to be merging, because if you see 11,000 debt, and if you observe here, effectively 14,000 debt, totally 25,000 millions, right? If I'm not mistaken, the bigger amount. So the biggest challenge for us is, in case if we are going to sell the stake, the biggest challenge is the financial risk. What be the risk we may face practically is the financial risk, because there will be a huge implication coming with that. And the second thing, how many players are there in the market? How many players are there in the market? Only 6 players, right? Now, the biggest challenge is, will they allow a market where there are a very small number of players to merge? Can KPMG, EY merge together? And for example, can PwC and Deloitte merge together? Yeah, but will the competition authorities allow them to merge together? That is the question I have to ask you. Technically speaking, yes or no, students? Answer is no, right? Because there will be a formation of monopoly. So there will be another risk. Formation of what, students? Monopoly. Although this industry may not be a dominant industry, but still competition authorities may have an eye. And then, students, if you see, the other risk is dilution of control. Now, this is what majority of the students may say. But in this case, students, dilution of control is wrong. Why do you think? Doctor, can you tell me why dilution of control is wrong in this case? Linon, can you think and tell me why dilution of control is wrong? Dilution of control is a theory, but that's what you have to think. What about Aditi? Aditi, why do you think dilution of control is wrong in this case? Anyone in the class? Dilution of control is wrong. Why? It's a wrong answer. What is the reason? Any answers? Okay, now students, if you observe this enterprise, do we have any major shareholders mentioned in the question, doctor? Do we have any major shareholders mentioned in this question?
No.
No. In real life, is there any companies where there is no major shareholders?
There are
There are.
generally
There
institutional shareholders, big shareholders.
institutional shareholders are there, but there are companies where it is purely funded by the general public. Correct, no, doctor?
Yeah.
That means too much of polarization, so many dispersion. So in that case, there is nothing called dilution of control, because if you observe in this organization, the entire stocks what are listed in the market has been taken by many investors. So this is effectively needs to be considered as a investment fund, if I'm not mistaken, like mutual fund, everything. They are not major investors. Correct, no, doctor, if I'm not mistaken. They don't control, they invest. And in this case, if you observe, there won't be major dilution for control. The reason is management may lose their control, but the shareholders may not have any issues with regards to that, because in this case, shareholders as invested in the organization just for expecting dividends and capital gain. Because students, you see, this time there is a dividend payout of 22% and the interest rate is 10%. So we can effectively observe, students, there is no major shareholders in this organization. And I'll give you another example also. Now, students, if you see here, the borrowing, if you see here, students, it's almost very much closer to the equity, if I'm not mistaken. In case if there are major shareholders, you will not be able to borrow so much of finance. The reason is they will always question why. So in this case, this is a fully quoted entity, fully flotation entity. So that is one factor. So that is the third risk, but you can write it down. But the other risk, if I'm not mistaken, is change in the business model. Doctor, is that a risk to our company? Change in the business model? Because
It
if you
is.
observe,
We
it
have
is.
Darland. We have Darland who
Correct.
do not produce any autonomous product.
Excellent. Excellent. So that is something very specific, because we have someone in Darlan. So it's something specific to that. So students, can I quickly get a confirmation from you all in the chat box, students, if you are fine with that Darlan point of view, because that is what matters at the end of the day, students. Because the loans are very high, because loans are very high. If there are institutional investors, they will not allow to be geared. Because before you take such a big loan, you have to ask questions from the investors in case if they are dominant investors. So those are the main factors, if I'm not mistaken. And the Darlan operations may cease. That is the ideology. So can we write down here? The first factor to be considered is the financial risk. Since both the companies are highly geared, can there be a possibility where the company will be able to merge, since the banks may restrict, because there will be a decrease in the credit rating. Students, credit rating is very important, because two merging companies will be very difficult. No, there won't be any changes. The second factor to be considered is the formation of monopoly. Will the government of Tesla allow companies to merge?
Sir, there are 6 players. Why would it form into a monopoly?
Yeah, if you see 6 players, these 2 players are effectively dominant. Example, let's assume Coca-Cola, Pepsi, and then there will be other parties, right? Like Thunder, so many things are there. But in this case, the 2 main people joining together, it will become a domination. Another example, I can say Apple and Samsung joining together will be a huge impact, if I'm not mistaken, for other people like Huawei, everyone. Are you clear with that, doctor?
Yeah. Yeah, now I understood. It will
This
be
will be
domination. It will be domination.
domination. It will
Yeah.
be domination and it will be very difficult to operate. Example, doctor, when we did our masters, there was a case study, India joining with China. What will happen to the manufacturing industry? It will be very hard, right, for the rest of the world. Correct, no, doctor, if I'm not mistaken,
Yeah.
because entire world GDP will come from that side. So allow the companies to merge will be an issue. Since 2 players can effectively dominate, the above are macro consideration. But the specific considerations can be changes to the business model. Since we also produce non-autonomous equipments, there are chances that the company will have a major challenge where sometimes the Darlan factory may be closed or updated for AGV and AMR. Therefore, there can be a major change. Similarly, I forgot to say leadership change can happen. Doctor, can there be a leadership change in case 60% stake goes out?
Huge possibility.
Yeah, that is different from dilution of control. Are you understanding now, doctor? Dilution of control is shareholders' control getting out. But
This
leadership
is
change
management
is
control.
management change, management control. Students, there's a distinction between shareholders and management. Now, Reliance organization belongs to Ambani. Ambani's stake has been taken over by Bill Gates, dilution of control. Are you clear with that, students? Tata management is being changed by Microsoft is a leadership change. Are you getting the understanding between the dilution of control and leadership change? Can I quickly get a double Y in the chat box? Dilution of control is like invasion. Leadership change is like political election. Every 5 years, the president and the prime minister changes. That is the difference. Similarly, leadership change can take place, which may affect the business decisions and long-term vision, mission, and values as well. There are chances that Robobryce can end up as a manufacturing subsidiary. In the future. Finally, the dilution of control in this case will be not applied since there are no major investors or proxies. Also, there are chances that the companies shareholders are purely general public. Therefore, this can be a major factor since the 60% stake can be sometimes a capital gain for the investors. Full stop. Students, are you understanding this? Can I get a confirmation from you all in the chat box? And I can understand that the theory section is very critical for this classroom. So we have to do a lot of recap, but I am very happy because you are a strategist. A strategist is the person who finds solutions by somewhat. Now you see you're writing answers. Doctor, are you understanding the new skill you are developing, doctor? That means you are innovative. Are you getting the outcome of this practice? Clear, no, doctor, what I'm saying here?
Yeah,
That means when
definitely.
you go to the exam, even if you don't know, you will write a good answer. Correct me if I'm wrong, doctor.
I like the online thing where I have a watch or clock to look at, and yeah,
Correct,
I
no,
like
doctor.
that.
So the thing is, students, I'm being very transparent. Don't worry about the marks. Don't look at the scoreboard until the match is over. That is the greatest advice I can tell you. Because if you always look at the scoreboard, you are not improving your performance. Just observe the feedback and the performance. And that innovation is what is important. Now, I think Jose have invented his own idea. Rahul has invented his own idea. And if you see, Linon improved his own idea. Ifzal, very good, your own idea. So that is what, as a teacher, I'm very much concerned, making you to write something in your own and giving you pressure. And you always need to think pressure is privilege in strategic level, because without pressure, you can't work in strategic level. Okay, so I'll go for the one-to-one discussion, and the mock is also ready. You can do the other mock also. So I'll start with Aditi. Aditi, any questions you have?
No, sir.
Thank you. Mr. Ifzal, any questions you have?
No, thank you so much.
Welcome. Mr. Jose, any questions you have? Dr. Sharmin, any questions you have?
No, sir, thank you.
Rahul, any questions you have?
No, sir. Thank you.
Jitmi, any questions you have?
No, sir. Thank you.
Thank you. Mr. Nirosh, any questions you have? Mr. Linon, any questions you have? Thank you. So thank you, students. We'll meet up on the Sunday class. Thank you very much. Have a good evening. Thank you, students.
Thank you, sir.